cheers.
Cheers.
Shall we kick this off?
Let's kick this off.
Good morning, everyone. I am Blake Oliver, CPA, talking today with Liz Wilke. It's been a wild year. Two things spring to mind. AI taking over the world, potentially changing everything we do as accountants, as white-collar professionals. And then right after that, we had Silicon Valley Bank collapsing and taking two other banks with it. And for a moment there, it was looking like we were going to have a recession, you know?
For a quick moment.
For like 2 weeks, we were all really freaking out. And then it kind of passed. And the recession has not materialized. We had a pretty nice summer, it seems like, right? We had Barbie, we had Oppenheimer, you know, we had our blockbusters. Seems like things are getting back to normal a little bit.
It does seem like things are getting back to normal, except I feel like we get these interludes between crises, right? ChatGPT took the world by storm, and then there was SVB, and, we've had sort of a nice summer. People are feeling a little relaxed, but you have to ask the question, like, what's the next thing, right? Because I do think we're in sort of a period of turmoil and change. And I think we all really want to, go back to the normal, and we really want to appreciate where we can just take a sigh of relief. But yeah, part of me is like, what's the next thing? Because there's going to be a next thing, that's just the moment that we're in.
So in your professional opinion, are we in for a soft landing, or is the recession coming?
Honestly, I'm pretty bullish on a soft landing. I think that if we have a recession, we're going to have, minus 1%. Like, we're going to sort of sit right at that 0% growth. And I honestly don't think it's coming till 2024, if it's coming at all.
Okay.
I think at the very beginning of the year, when my economist friends and circles were like, oh, it's going to happen. It's just a matter of time. And I was like, these labor market numbers are at best drifting sideways, right? These consumers are spending so much money. And I think they're really like the wind beneath the wings for, these jacked up interest rates. And I think they're really going to bring us into a soft landing, or there's a lot of space for that to happen, right? Which is exactly what Jerome Powell is counting on.
So soft landing or mild recession is what it sounds like.
Yeah. But I think most people, especially if you're younger, remember the 2008 recession, right? So recession is like recession with a capital R.
Yeah.
It seems really big. But recessions can be really mild. They can be technical recessions, right, where people just feel a little like it's not as good as it could be, but it's really not so bad. And I think that's where we're headed. I don't think we're headed for a capital R recession.
Oh, good. That's good, because I have PTSD still from the Great Recession. Not a good time to be graduating from college.
It was a terrible time to be graduating from college. Although a bunch of people went to grad school right out. They were like, I'm out. I'm not going in this labor market. Get some more education.
A bunch of my friends became lawyers. That was the go-to. Okay, so recession. Maybe we don't have one. Maybe we have a mild one. The cause of the next recession, right? We thought maybe it was going to be this SVB thing, or it looked like that was going to set things off. And we were going to have this banking contagion, and all of the small banks were going to have trouble, and that's bad for business because small businesses
they depend on those banks,
on those regional banks, and it didn't happen. Why didn't we get that? How did we save the day? FDIC was enough. The Fed stepped in and everybody was like, okay, we're going to be all right.
To be honest, kind of, yeah. I think
they did their job.
I really do think that the Fed did their job in this case. I think that with the controls in place from the Dodd-Frank Act, I really do think there were a lot of lessons learned from the bank failures of the financial crisis. And, to put it in perspective, the amount of money wrapped up in these three failed banks equals the amount of money in the financial crisis that failed. So the magnitude of the failure is totally on par, and we just did not see the fallout that we saw in 2008. And that is because of these improved governance standards that were put in from the Dodd-Frank Act. But the Fed came in and they did its job. They said, don't worry, we know how to solve this. Like, everybody's going to get their money back, right? And that really helped to calm the fear, right, that causes that contagion. And then they quietly transferred it to receivership and found a buyer, and then we could all sort of get on as normal. And I think I don't think the Fed got the right kind of credit that I think it deserves, right, for dealing with the situation as smoothly as it did, because we had the almost exact same situation 13 years ago and it was chaos.
Yeah.
Yeah.
So we escaped this immediate problem. The three banks went under, right? It was what?
First
SVB,
Republic,
First
SVB.
Signature.
Yeah.
Was the other one. The other banks, didn't get impacted, or they're okay. But the underlying issue that caused all this, which is the interest rates going up, that hasn't gone away.
No.
So it's sort of like, we've dealt with the symptoms of this disease, but the underlying condition, which is these high interest rates that caused SVB to collapse, like that's still there. So, I mean, are we really out of the woods?
I would say the risk is still present, right? Which is what you're trying to say. The risk is still there. So a lot of banks, especially small and regional banks, have assets on their balance sheet, right, that were put on there way back when interest rates were really low. We'll talk about commercial real estate loans in this context, I expect, because it's sort of the elephant in the room for them. But the risk is gonna be there. I think honestly, it's sort of anybody's guess at this point how that's going to fall out, because whether or not it's going to be a calamity or kind of just like, what has already happened, where it sort of silently and smoothly happens, it really depends on how much the Fed wants to step in, right, every single time this happens,
right,
and facilitate, honestly, what's probably going to be a bunch of mergers and acquisitions, right, in this space as that risk sort of unfolds.
So just have the bigger banks get bigger, buy up the struggling smaller banks, and you solve the problem. Get the balance sheets in order that way.
I mean, you solve a problem, right, with that. So one of two things I think is most likely to happen. Either small and community banks are going to come under stress because the real estate loans and the assets that they have will come under stress. And then they will either fail and go into receivership, right, like SVB, and then they'll be bought up, or the additional regulatory requirements that will be put on them, because they were previously exempt, right? Small and regional banks didn't have to do the kind of stress testing, right, that bigger banks have to do.
The Dodd-Frank
exactly.
stuff. Okay.
Yeah. But so if the Fed is like, hey, there's all these risks and you guys need to be doing a lot more, small and regional banks may say, we can't support that, right, and still serve our customers. So then they'll just sort of be bought up and there will be this consolidation. So you sort of solve some of the risk part in the financial system overall. But I think one of the real knock-on effects for small businesses is that where's their money going to come from, right? These relational banking systems are really, really important to small businesses.
Right.
And if those businesses aren't there anymore, they're being run by B of A or Citibank, what's going to happen to that source of finance for them? And I think that's the real open question that we need to think forward about how we're going to address.
Yeah, that's not a great situation. I mean, I own a business. I've had a firm, and trying to get B of A to give me the time of day, is not something they do really for a small business. But that, local bank who has like a person I know in the community will talk to me, will give me the loan that I need to start my business.
Well, they understand your business. They understand the local market for your business, and they can have a real close eye on whether or not you're profitable, right? I think especially if you're in not a major city or you're in a rural area, it can be really hard to know how successful your business can be, right? Which is how you want to make a loan.
So we talked about interest rate. Interest rates staying high for a while seems to be like what I'm hearing.
Yeah, I think it's going to be high for a while.
Okay. Yeah, because the rule of thumb is the Fed can't lower interest rates while the job market is still hot, right?
I mean, not to put too fine a point on it, but yeah, that's about right.
Right?
Yeah.
Because like the idea is, correct me if I'm wrong on this, it's very simple, really. They raise interest rates until unemployment starts to go up, right? And then if unemployment's going up, that means the economy is cooling down. So now they can start lowering the interest rates.
Yeah.
But that hasn't happened. If anything, the labor market has tightened as we've gone up.
Yeah, I mean, so that was the traditional logic. But honestly, we're in unprecedented times. And I think I've been saying this sort of since last year, is like our old models and ways of thinking about the economy, it's not that we can't use them. It's that we need to use them with a healthy openness, all right, about how they could be wrong in this environment. Because I think we really are in some uncharted territory, right? The magnitude of the change from the pandemic, all the retirements, this huge surge of entrepreneurship, all of the changing industry needs and the digitalization that happened during COVID, like, is still playing out. And so I think what we're seeing is, yeah, you would think I jack up interest rates, people become unemployed, businesses slow down. We've at best drifted sideways in the labor market, but we have made significant progress on inflation.
We've slowed down the rate of inflation.
Mm-hmm.
We haven't got, what do they call it? It's not disinflation.
Yeah.
We haven't gotten that. Where I was going with this is thinking, like, we're just going to have high interest rates for a really long time now.
So what I expect to happen is that they'll start taking pauses, right? Or at least skipping rate increases. You know, we're up at a 22-year high. We might get a couple more bumps, but now that we're seeing inflation cool, my best guess is that they'll probably just think, let's just keep it here for a while, as long as it takes. And if inflation stalls, we can turn up the notch. And if inflation keeps going down and the labor market's healthy, then we might actually have this sort of unprecedented situation where we have really robust labor market and 2% inflation. Yeah. I don't think that'll happen, because I think that model about uninflation and interest rates is still basically true. But I think we can expect higher interest rates well into 2024, if not 2025. I just think it's going to take a long time for that to work itself out.
So that's how we come back to the banks, because if interest rates are going to stay high, the banks have been enjoying all of this cheap, almost free for them money.
Yeah.
So they basically take money from the Fed, they loan it out to businesses, real estate often, and it's easy to make a profit because they don't have to make that much on the money that's free.
Yeah.
But now when money costs what, I don't know what the federal funds rate is, but it's like what,
5.5%.
Yeah, right. So when they're paying 5.5%, what do they have to earn on the loans that they're putting out there?
Yeah.
It's not small.
Yeah.
So their margin is thin.
Yeah.
And you mentioned on your podcast that, and this is what stuck in my head, is that these regional banks, these small banks, 80-90% of them have a significant amount of commercial real estate debt on their balance sheets. And that was all financed at these really super low interest rates.
Super low interest rates. And so when you think about giving out a loan at the beginning, right, most of the time, like when you get a mortgage on your house, right, you know, you originate the whole loan, right? And you say, I'm going to get a loan for this whole house, right? And you do it at a time where you think you're likely to be able to pay it off into the future. That's not how it works with commercial real estate loans, which is why it's sort of so interesting. When you do commercial real estate, you get a loan for the whole amount, but you only finance it for like 7 years, somewhere between 5 and 10 years. And so you basically have a payment schedule. And then at the end of 5, 7, or 10 years, you have to pay the whole rest of it in this balloon payment.
Which is not even possible.
Right. So you refinance it, right? And then you get an amount for like the next 7 to 10 years. Right. So when all these loans were originated that are coming due, you know, you have to pay a significant chunk that needs to be refinanced, but the value of the loan that you originally got, which you need to refinance, is from when the money was cheap and assets were really highly valued. So you have much less profitable projects that needs to be valued at the old value. And so we expect banks to take losses on these, right? Because they just won't be profitable.
Right. And they haven't had to do it yet because they're holding all these loans on their books at historical values.
Yeah.
Right. So that hasn't been marked to market. So that's the landmine that could be there. That's like, right. That's
the landmine. Yeah.
We might not know. I mean, and what could be, how much could these shrink? Right.
I mean, what office rates are down 20, 30% in some areas since the pandemic. Some places they're not down quite so much. But I mean, they're especially in like big cities, right, that are highly remote workable and where people have moved out to the suburbs or are only coming in 1 or 2 days a week. I mean, the value of these loans could go down significantly, right? And you sort of get these like jingle mail that became very popular in the financial crisis, where people would just mail the keys back to the bank, right? Stop the payments and sort of call it in. And, you know, you can see that.
This is giving me echoes of the Great Recession, you know, because that was a mortgage crisis, right? And it was essentially, I mean, in some ways, it was very similar to what you're describing.
Yeah.
So, where, everyone's on these variable rate loans. And suddenly the interest rates go up and now nobody can afford them.
Yeah.
And it's basically the owners of these buildings low occupancy.
Mm-hmm.
Their renters are going to churn out,
Mm-hmm.
and now the property's not worth what it was, and suddenly their payments are going to have to go way up.
Yeah,
So
that's right.
are the banks going to end up owning a bunch of commercial real estate?
Maybe so.
You know?
Yeah. I mean, somebody's going to own up somebody's going to end up owning it. And I think the saving grace of some of these banks will really determine how much of their commercial portfolio is in office space. Because other types of commercial real estate are doing quite well. Warehouses are doing particularly well.
Oh yeah, good point.
Right.
Yeah.
So like retail space actually is doing better than you would think, especially since we're, our online shopping trends are actually returning to normal. And so retail spaces, having a little bit of a resurgence. So specifically hotels, right? Specifically office space is really struggling. So if you're a small bank and, you're financing hotels and warehouses and stuff, this is not a thing for you to worry about, right? Those things are going to get refinanced overall.
Okay. That's good. That gives me comfort. So I'm thinking, I was picturing the balance sheets, and I'm thinking, a quarter of the balance sheet is these commercial loans. Yeah. If those all go bad, I mean, banks don't operate on a lot of equity.
They do not.
Right?
No.
Their net position is pretty slim. Yeah. And that was the case with SVB.
That's definitely the case with SVB.
Yeah.
I mean, you can definitely go and look at a bank's balance sheet. I think in my podcast, we put in the show notes where you can actually go and look at that information. But the thing to look at is how much of the total balance sheet is in commercial real estate and then how much of that is in offices. There are definitely banks out there who are holding 20% of their assets in offices.
Yeah, that
and
I
those
would be
banks,
worried about.
If that portfolio loses 20% of its value, it took much less than that in a loss, right, to create a run on SVB.
Yep. Okay, so those are the banks we need to look out for.
Yeah, those are the banks we need to look out for.
Do they typically disclose the breakdown of the commercial real estate portfolio?
They typically do.
Okay, so we can look into the financials and we can see it.
Yeah.
Right, that sounds like a job for ChatGPT.
It sounds like a job for somebody, for sure.
I'm not reading 180 pages of financial statements.
Yeah, right now you have to go through one by one. It's much easier to look at like what's my specific bank doing, right? As opposed to, generating the whole list of banks that you really want to keep an eye on.
Okay, I'm going to go do some homework. Homework for our listeners is to listen to your new podcast.
Yeah.
It's called the Gustonomics Podcast.
The Gustonomics Podcast.
And that was really the impetus for this discussion. Was your first episode is all about commercial real estate.
That's right.
Loans and how they work. And I didn't know about that balloon thing that happens at the end of 7 years or whatever. But that's really fascinating. Like you wonder, like why? Imagine if we all had that on our houses. And you had to refinance every 5 or 6 years.
Yeah, I mean, I think the way mortgages work is so different, right? And we just don't think about all the other ways that loans could be structured. Yeah. Some of them are really not so good, right, for the people doing the borrowing.
But in a way, it's like kicking the can down the road is what happens with those commercial loans.
Yeah, that's exactly what happens.
And it works well as long as the economy is growing and the buildings have occupancy and, but not so good if it turns the other way.
Yeah, well, it also, could work well if just interest rates, right? If you sort of don't have these big jumps in interest rates, right? Or you have some kind of a bridge program to sort of help, you say, you could imagine a program where you say, the interest rate on your specific loan can sort of never go up by more than that or amount of the other, which is a protection that was put in for variable mortgages right after the financial crisis. We haven't faced those problems yet, but I sort of imagine we could be having those conversations about commercial real estate loans.
So everyone check out the Gustonomics podcast. And also, Gusto does really incredible research.
Thank you.
Reporting.
Yes, I think we do.
I think the last one was in August.
That's right.
We'll put the link to that report in the show notes. Anything in particular you want to call out from that study?
I think I would just call out, really, it's the talent market that I think we're transitioning from this idea that the talent shortage, the Great Resignation, is like a temporary thing that we're working through. And I think we just need to get ready for the forever talent shortage. I think that talent and workers are going to be scarce for some time. And, we are just going to have to figure out how to retain, how to train, how to develop people. So that whole program is called The Economy Explained. We put out a quarterly video blog post to sort of talk about big trends in the economy and what they mean.
Forever talent shortage, and sounds like maybe forever interest rates.
Maybe forever interest rates. Definitely medium-term interest rates. For a while, interest rates.
No. None of us can ever move again. If you bought a house, you're stuck.
Well, that's why housing prices haven't gone down, right? So interest rates went up. Everybody who owns a house owns it, at 3% or less. And they're like, well, I can't buy a better house than the one I have now. So they took their house on the market off the market, or they're not putting it back on. And so all the buyers in the market are not only facing an increased interest rate, but they're not even getting that housing price reduction, right? That you would think of as being, the result of a higher interest rate. But
everything's counterintuitive. It's like the opposite of what we learned in school growing up. And it must be an exciting time to be an economist.
Yeah, mostly because people are really exciting. I say in the podcast, and I will say it a lot, is that the economy is just people doing people stuff with other people all the time, right? And the dynamics of that are always rich and complex, and even more so in this time.
Well, thanks for talking with me, Liz.
Thanks,
This was a pleasure.
Yeah, it was a pleasure.